building a better portfolio, average investor equity performance. And this is one of my favorite segments of Ericsson University, as we can actually show how to build a better portfolio. And this is actually how we, using the academic approach, build your portfolio specifically. And it's not quite as, it's going to show a more simple view, but just know that this is the fundamentals of how your portfolio does what it does. Now let's take a look at the average investor. Based on the Dalbar study, the average investor underperforms the market. And by the market, I mean we're using the U.S. Fortune 500 company. It's called the S&P 500. But we can see that by the Dalbar, what they did is they actually looked at many portfolios of actual investors that were buying equity or stock mutual funds. And they looked at all of their statements to see exactly what their actual performance net of fees were. And they used a period of 1991 to 2010. And what they found was shocking, that while the market was doing roughly 9% per year, the actual performance of the investors only did 3.83% per year. And you can see also they have a high standard deviation of 19.79. So the goal of building the portfolio is to maximize returns while minimizing risk. Well, what the actual investors here did based on the Dalbar study was they took on stock market risk, but actually performed like a fixed income fund. So it was the worst that could happen. So this is portfolio one. Let's look at some specific examples of why these investors perform so poorly. First of all, they had a very low holding period. They were only in these portfolios 3.27 years. That's the number one rule to not break, is that you buy and hold and you rebalance. So we'll talk about that in a different segment. They also perform what they call track record investing. They actually pick the fund managers based on how well they did in the past, thinking they would duplicate those returns. They also exercise hyperactive stock picking. That means that they bought and sold many stocks rapidly throughout the year, or they picked the manager and they maybe didn't even realize it, but the manager was actively stock picking. And the typical active mutual fund, historically on average, turns over the stock portfolio 100%, meaning that they're changing the whole portfolio from the beginning of the year to the end of the year. It's all different stocks in the portfolio. And last but not least was market timing. Market timing means that they were changing their mix of their portfolio based on some type of predictive event, meaning that they were saying, okay, I don't feel good about the economy right now, so I'm going to move out of the stocks. Or I feel good about the economy, now I'm going to finally move into the stocks. Or I want to go into gold, I want to go into this segment. And unfortunately, some active mutual funds, even if you don't want to do market timing, they will do market timing for you. Now, this is the fundamentals of creating a diversified portfolios. And we showed you portfolio one, which was the actual investor earning 3.83% per year. And this is the S&P 500, and this is just a passive fund of the Fortune 500 stocks. And you can see if you just stayed in this fund, you would have had 9.81% per year for all these years going back to 1973 on average. And your standard deviation would have been less than what the actual investors did of 18.53. So step number one is don't do the bad behavior of portfolio one. So then you go to portfolio two, which is a passive fund of the S&P 500. Now I think we can actually do better, and your portfolios have done better. Here's the next step of trying to increase the returns and reducing the risk. All we're going to do simply is add two elements. We're going to take 40% from the S&P 500 and add a 5-year government bond at 20% and a 1-year fixed income index of bonds at 20%. Just by doing that, we're taking 40% out of the stock market, and look what happens. Even though the portfolio return is slightly less at 9.26, look at how much we've reduced the volatility as measured by standard deviation. We've taken it from 18.53 down to 11.66. We've only slightly diminished your return, but we've actually reduced your volatility, which causes people to lose sleep at night when they get their statements. We've reduced your volatility by about 55%, almost 60%. Now, I think we can do even better. Let's look at adding some international stocks in the portfolio. So now what we've done is we're taking 30% of the stocks away from the S&P 500, moving it over to the EAFE index, which is the large growth stock index of foreign companies. Just by doing that, now we've increased the return back going up to 9.33, and we've actually kept the standard deviation volatility pretty similar to what the previous portfolio was. So we're kind of going back in the right direction. And again, I think we can do better. Let's add small cap stocks. We're going to add in portfolio 5 U.S. small companies and an index of international small companies. So now we only have 15% in the U.S. S&P 500. We have 15% in the international large growth index of stocks, and now we've added 15 into small U.S. and 15 into international. Look what that does. If you go to the right in standard deviation, it does slightly increase the deviation, but look at the returns. We've increased them up now to 10.49%. So again, this is a winning formula. First of all, we're not even going to compare it to what actual investors are doing. Just looking at the S&P 500 index of 9.81, we've increased the return by about 0.7% per year, which is significant, and we've still reduced the risk by about 45%. So it's a significant decrease. So in a nutshell, and then there's one more we can add: value stocks. Hard to read, and I appreciate that. So look at portfolio 6 and read the small print. But really, what we've done is we've added some U.S. small cap value and U.S. large cap value. And look at this. We've now started reducing the risk again down, as measured by standard deviation, down to 12.12, and we've increased the return now up to 10.99. Portfolio 6 is the closest analogy to how we build your specific portfolio for you people that are watching this, watching this episode of Erickson University. This is how we build your portfolio. We increase the returns and reduce the risk, and that's a winning formula. Now, the beauty of you just going through this episode is you're now going to be able to answer some additional questions on the 20 must answer question. Question number 10, when it comes to building your portfolio, do you exactly know what you're doing and why? That last slide I just showed you can now allow you to say, yes, now I know how my portfolio is being built. We're adding multiple asset classes, increasing the returns, and reducing the volatility risk. So this is how we do it. Question number 15, do you understand the implications and applications of diversification in your portfolio? Now you can see by what we just did in this Erickson University episode that by applying diversification in your portfolio, the full implication is we are increasing your returns over the long run and reducing the risk. So I think now you can check this with an affirmative yes. And question 16, do you have a system to measure portfolio volatility? Now specifically, you might not have a system, but we just showed you how we measure portfolio volatility by building portfolios using that measurement called standard deviation. We can take any portfolio and access the University of Chicago CRSP database, which measures and updates daily every security holding in every portfolio. And what we can do is we can actually measure the volatility. So yes, you do have a system, even though that you're going to rely maybe our access to the CRSP database, but yes, you do have a system to measure portfolio volatility, and I believe you should be able to now say an affirmative yes. We will see you next time.